Welcome back to the channel. Today we have another special guest with us. We're going to talk about a new fund that I actually met this guy at a pizza shop, just randomly going down the street. Not randomly, but I knew he was going to be there. So I was stalking him. So David, go ahead and introduce yourself.
I'm the founder of Quantify Funds. We are a new ETF issuer. We launched our first ETF in October. I'm a 25-year vet in the ETF industry. First as a portfolio manager, and then as one of the first few employees for what was then Toroso Investments and what is now called Title Financial Group, both as a portfolio manager, and I worked on the new product development team as well. So after about 11 years with Title, I decided to partner with Title and become a Title client with Quantify Funds here. And our first ETF is the STKd 100% Bitcoin and 100% Gold ETF. The ticker is BTGD, BT for Bitcoin, GD for gold. We trade on NASDAQ. We, as I alluded to, we launched in mid-October last year, 2024. We're up just around 100% since inception, so it's been a really good ride. And I'd say the simplest way to think about it is this is a portfolio that is a mix of half Bitcoin and half gold, but the overall portfolio has 200% exposure. So unlike traditional leverage ETFs you might have heard of in the past, in mid-October last year, 2024, we're up just around 100% since inception. So it's been a really good ride. And I'd say the simplest way to think about it is this is a portfolio that is a mix of half Bitcoin and half gold, but the overall portfolio has 200% exposure. We actually have some form of rebalancing that we can do within the ETF, and we can rebalance between our Bitcoin and gold exposure. And we'll get into more greater detail later on this call. But what that does is it alleviates some of the path dependency that you see with traditional leverage ETFs. Leverage ETFs can be very, very good tools for your portfolio, but they have to be rebalanced. And the real question is, are you going to be doing all of those really difficult rebalancing periods at the extremes? And in this case, are you going to be buying Bitcoin when it drops to 80,000 and trimming gold to buy that Bitcoin, or vice versa now when you see Bitcoin rallying and rebalancing back the other way? Anyway, longest intro ever, but Brad, I'm so grateful to be here and thank you for having us, and excited to be on your show.
It takes out that emotion. I mean, it's that emotional dependency of, oh, I gotta sell this to buy this, and it just takes that out of play. How do you actually get the exposure to Bitcoin and to gold in your fund?
Yeah, so we don't actually have to use margin in our account. We get our leverage through the futures market. So the majority of our assets are going to be futures exposure to Bitcoin and futures exposure to gold. We'll also own some exchange traded products in the Bitcoin and gold space just to round out the portfolio. And it's cost effective from a trading perspective if you're balancing back and forth. But if we take a step back, I would say this relates most commonly to the first stacking concept in the 40 Act lineup, mutual funds and ETFs being the PIMCO funds that you saw back in the 90s. If you recall PIMCO stock plus funds, these were funds still in existence that stack broad equities on top of broad fixed income. And the concept is, we were talking about this before the call, is leverage can be beneficial if used intelligently and monitored. But oftentimes when leverage is used, it's not rebalanced. And if you have a leverage ETF, you have this daily disclosure intended just for daily use. By having some level of diversification within our fund, we don't have that daily disclosure. You have to trade that leverage ETF, that traditional leverage ETF, potentially 3 or 4 times a week. And if you do that, you can get really, really close to your intended leverage ratio that you're trying to acquire. But what ends up happening is institutional trades leverage ETFs in and out on a regular basis, and retail ends up just buying and holding. So what we wanted to do here is create a product that, Bitcoin and gold is what we call like the prepackaged currency debasement hedge in one ETF with the ticker BTGD. It allows you to have that monetary hedge against the eventual decline of the US dollar in one basket and remove the emotion of having to rebalance between the two. And there's real value in taking two assets that are somewhat uncorrelated and rebalancing between the two. We saw that with stocks and bonds in the 2010s, and that's true now in the 2020s with Bitcoin and gold.
Is it really 100% and 100%? And are you rebalancing daily, weekly, bi-daily, every hour? How do you do this?
So it is really 100% and 100%, and we rebalance on a drift basis. So typically somewhere between 4 to 7% in drift between our Bitcoin and gold exposure will trigger a balance. It is actively managed, but we're not trying to outperform that. We're just trying to, in a cost-effective manner, considering trading costs and taxes, give that 100% and 100% exposure. We end up trading usually about 2 to 3 times a week, so about half the time. So the onus that you would have as the allocator to leverage ETFs to rebalance, we are now taking internally, doing that within this fund by doing these small tweaks back and forth, generally 2 to 3 times a week.
What's the expense ratio?
Our expense ratio is 1%, so pretty cost effective in the leverage ETF world. And again, the concept is to always have almost 100% exposure between both. So for example, if gold is flat over a 1 month period, we should basically return the performance of Bitcoin. Really, it'll be the performance of Bitcoin then minus the cost of leverage. But that's the beauty of these ETFs. Our leverage costs are, right around, maybe call it 5%. And most individual retail investors, as well as financial advisors, can't get that kind of cost-effective leverage on their overall book of business. And so that's why these strategies have been so popular in the ETF wrapper, because they embed those very cost-effective institutional leverage ratios in the portfolio. And I know some people, some Bitcoin maxis might look at crypto in futures exposure and roll their eyes. But over the last couple of years, we've had a number of very volatile events in the crypto market, and that front month future has traded exceptionally well.
David, can you go into us and show us, what you have seen in the past on rebalancing and how this might actually be able to perform better having you do it than us trying to do it ourselves?
Yeah, absolutely. If you go to our website, you can see quantifyfunds.com. We have a nice paper called The Case for Bitcoin and Gold. This is the paper here in front of you. So how do you hedge against currency debasement? Obviously, there's an unbelievable amount of interesting tools in the ETF landscape, especially what we've seen in the last couple of years with the derivative rule changes happening in 2020 and 2021. A lot of them are shown here today. So I'll just go through a few of these. This is a risk reward chart showing the returns and risk of BTGD versus Bitcoin ETFs, gold ETFs, 2 times Bitcoin ETFs, 2 times gold ETFs. We have gold miners, junior gold miners, leverage gold miners. We have MSTY, we have MSTX. We have stacked products from WisdomTree that others use, GDE and GDMN stacking S&P and gold and gold miners. And you can see here, if you really choose 2 assets to stack that have good correlation benefits, you get a lot more return with just a little bit more risk. So again, on the bottom line here is the standard deviation. You'll see that BTGD has just slightly more risk than IBIT here, so than the largest Bitcoin ETF. So slightly more risk than IBIT, but significantly more returns. And the amount more should generally be about the returns of a gold ETF minus that 5% cost of leverage.
And the benefit is that this is, a little more risk, but more performance for that risk.
And again, in terms of like how you choose your investments, one metric to look at is a Sharpe ratio. I don't want to bore people with like really complex finance terms, but Sharpe ratio is a good way to look at a number of different investments and see how it performs relative to how much risk it's taking. So you can see here the dark green is gold and leverage gold. Leverage gold is still efficient, but less efficient than regular gold. You have Bitcoin and leverage Bitcoin. Again, leverage Bitcoin is efficient, but a little bit less efficient than Bitcoin on its own. You have all the other ETFs shown on the chart above as well. And stacking 2 assets that have that correlation benefit, you see the Sharpe ratio of BTGD surpassing all of them here, because those are, in our opinion, the best to pair from a correlation benefit. They have a long-term correlation of about 4% between Bitcoin and gold.
So breaking this down for the everyday user, higher Sharpe ratio, better performance, correct?
More performance for each unit of risk taken, right? So like obviously if you go to the riskiest thing in the world, you can have really good returns, but are you getting compensated for that level of risk that you're taking? So Sharpe ratio is a good way to look at how you're being compensated for a specific unit of risk you're taking. BTG has plenty of volatility. That's why it's obviously also returned very well, in addition to having just a little more volatility than, for example, just plain Bitcoin. But it has been, at least since inception, the most efficient Sharpe ratio of the group. Another way to look at it and ask, like, why did we choose to stack Bitcoin on top of gold? This is a chart that shows all of Bitcoin's 15% drawdowns. So, when you have a leverage asset, if you're leveraging two assets, the real question is, when one does really poorly, how is the other one going to do, right? Over the last 9 months, we've seen in different locksteps, both Bitcoin and gold perform very strongly. And so that has benefited, almost adding the two on top of each other since the inception of our ETF. But if you look at periods when Bitcoin has done really poorly, one of which being this year, Bitcoin did have a 26% drawdown from the end of December to the low at 80 this year. You can see how well gold really holds up. So while we have 200% exposure overall to Bitcoin and gold, half Bitcoin and half gold, when our volatile asset, which is Bitcoin, has a lot of volatility, that's when gold is performing well. But to go full circle to the start of the conversation, that's also the time that you need to be trimming your gold and buying your Bitcoin, right? Or vice versa, when Bitcoin rallies 20%, trimming your Bitcoin and buying your gold. We found that there are many allocators who have allocated to both of these products. And honestly, I'd love to spend some time talking about the benefits of these products going forward, even though both of these assets are near all-time highs. Stacking these two has added more value than just holding two traditional leverage ETFs in this space.
Correct. And I hold both gold and Bitcoin. So this would benefit me. It takes away that I have to do both simultaneously, because I'm not a disciplined investor like that. And most people aren't. So this does that for us.
And if you want to talk a little bit more about the prospects of where we are with Bitcoin and gold more granularly, I think a lot of people see an asset class that is near an all-time high and get a little bit worried. Look, another asset class that's near an all-time high is U.S. real estate and the S&P 500. So all of these risk assets are near their all-time high. And so you have to ask yourself, which ones have a lot of value going forward? So I'll just take a step back and say, one of the things I hear much less about these days from Bitcoin people is talking about the supply of Bitcoin each year through mining. So after the last halving, Bitcoin mines at about 0.86% per year, meaning there's less than 1% of new supply of Bitcoin each year. Gold mines at about 1.75% per year, meaning less than 2% new supply of gold. Paper currencies on average, historically, print about 7 to 9% a year. So that's where the demand comes from. There's always more currencies being printed, and there's fewer and fewer Bitcoin and gold made available through mining. And that's why we wanted to prepackage this 2-in-1 currency debasement hedge in the STKd Bitcoin and gold ETF, ticker BTGD. And if you look at, for example, gold supply, 1/3 of gold supply right now is being bought directly by central banks. And it has been for the last couple of years. So they find gold, 1/3 of it literally goes straight to central banks. If you look at what's happening in the ETF space with Bitcoin, the amount of Bitcoin that the ETF space and the treasury companies are gobbling up is astronomical, much, much greater than that 1% supply. And this is before financial advisors even get into Bitcoin. Most of the major firms on Wall Street still do not allow their advisory clients to own Bitcoin on discretion from the financial advisor. And the ones that do have just small percentage points. And you would think that might be different in gold, but it's actually not. The institutional world, in some cases has some gold, and some people are true gold bugs. But on average, the institutional world, the pension funds, etc., they just have percentage points in gold. So we think there's actually a lot more room to run. And, the worst term on Wall Street is this time is different. But when you're talking about our fiscal cliff, this time really might be different. I love the work from Lyd Alden, and she has this fantastic quote from Breaking Bad that nothing stops this train, in reference to the fiscal cliff that our country finds ourselves in. And when you frame the world from that perspective, it makes sense. Oh my gosh, gold's up, Bitcoin's up, stocks are up, real estate is up. But guess what? Real estate is not supply constrained by 1 or 2%. Stocks aren't as supply constrained. Bitcoin and gold are what we feel as the two premier scarcity assets in both physical and digital form.
That's right. I was reading the other day that the treasury companies are essentially causing another halving just by their purchasing power, because the amount of Bitcoin that they're actually purchasing is simulating the next halving, which is right around 1,000 days, if I don't I'm correct, to the next halving.
Yeah, that sounds about right. And I think the writing's on the wall is like, we either have to get our fiscal house in order in the US, which even if we get our fiscal house in order, that still means printing on an average 7 to 9%. So that still has the inevitable long-term price targets of Bitcoin that you hear everyone on the street talking about. It might extend it from a couple of years to 10 years. Either way, these are true scarcity assets. As long as institutions continue to value them as such, and what we're hearing from the institutional world is that this is an asset that can no longer be ignored. It is so big in size and has such a nice track record over this 15, 18-year period that it truly just cannot be ignored anymore from institutions.
When you talk about money printing, I look at the M2 money supply. Is that similar to what you're looking at?
Yeah, I think the thing that drives Bitcoin the most is the M2 money supply and gold, right? So it's a hybrid somewhere between like a barometer for global liquidity and also a true store of value in gold. And we've seen that shift over time and it become even a little bit more like gold than M2, or at least have less data to the M2. But people keep comparing Bitcoin to the Qs and to stocks. 3 years ago, Bitcoin is a 3x Qs, and now it's a 1x Q. But that's not necessarily the case. I think it's just that both stocks and Bitcoin correlate to M2, as you alluded to. And the question is, as we continue to go higher and higher in our deficits, what will run more as that M2 keeps shooting up? Is it going to be stocks, which, yes, they will likely go up, but the supply constraint that's built into both Bitcoin and gold allow for this asymmetric potential on the upside that I don't think is equal to what you'll see in the overall stock market.
Correct. That you nailed that one down, because there are so many stocks that M2 gets dispersed among a whole lot of assets compared to a particular asset or singular asset that is scarce. There's only so much inflation or inflationary pressure on Bitcoin and gold. And once after the next halving, that Bitcoin even goes to, even less scarcity than gold.
Yeah, absolutely. Yeah. So we also have 4 other funds that are about 3.5 months old, that we take that same concept of stacking and we stack 2 different stocks on top of each other. I'll pull them up right now so you can see them. But we have 4 different stock pairs live. We have the STKd 100% MSTR and 100% coin ETF, ticker APED. We have Lays and Spicy for NVIDIA pairs in the AI space. So we have NVIDIA and AMD for Lays, NVIDIA and SMCI for Spicy, and then a driverless car theme with Tesla and Uber with the ticker ZIPP. These funds have actually performed phenomenally well. Obviously, AI is rallying right now. Crypto has been rallying. So these funds are, based on which fund, somewhere between 60 and 85% since returns in just a very short period of time. And so I would say these are more trading tools that you can use to express your viewpoint and your opinion on different, what we like to call almost mega cap stocks in these specific industries. Here we have crypto, AI, and obviously driverless cars. But again, allowing for some level of rebalancing between the two, which you saw in Bitcoin and gold, can be very, very valuable. And if you think about it, like, MicroStrategy and Coinbase don't always move in lockstep one for one. Right? Coinbase had a huge pop in the last couple of weeks with all the talks around stable coins that affected MicroStrategy a little bit less. And MicroStrategy might move on more on debt issuance from that company, et cetera. And just allowing yourself to have leverage with some diversification built in, it has proven to be mathematically much more valuable on a risk-adjusted basis than just having those 2 individual high-risk positions on their own.
An everyday retail investor, this was something that wasn't available to them 10 years ago. This is all more 3 years or less in the availability, just like some of the new income funds were not available. So
that's the beauty of the ETF wrapper. We're bringing institutional strategies available to everyone who wants to do the research and find them. People talk about, like, what are the margin rates on income products, et cetera. You don't actually have to worry about that if you tactically embed margin in your portfolio with something like this, right? Like a 5% allocation to this gives you 5% margin overall. And, for a lot of the people who are being very successful monetizing the income from Bitcoin treasury companies, gold is a really good option to drip into. And I know there's some FOMO to miss out on the Bitcoin trade than if you're doing gold, but that's why we actually think this is a great drip asset for a lot of those income vehicles, because you don't have to worry about the MNAV of Bitcoin treasury companies, and you get the diversification benefits of gold embedded into this one ETF.
David, thank you for coming on to the channel and educating us. And I really appreciate the education today.
Of course.
Thank you.
Truly a pleasure. Thank you so much. You have an amazing show, and so happy to be a part of it. And thank you all for your time today.